So I just wanted to talk, as Justin mentioned, talk briefly on the ongoing issues in the energy market and what that might mean for domestic energy stocks. So you might have heard reports about price caps and the potential for blackouts, as well as higher retail costs coming through. And so it's important to distinguish between what's happening in the short term and what this could mean in the medium term, which is probably more important for valuations. So firstly, we've entered what's known as an administered price cap in the four major states in the national electricity markets, so Queensland, New South Wales, South Australia and Victoria. So this is something that happens automatically if the average price over a week exceeds a predefined threshold, and it stays in place until energy offers from the generators bring that average down below the threshold. So it's meant to give the electricity market participants time to make arrangements to ensure they can continue to supply the market appropriately. Now at the moment, there has been some reports of some potential game playing going on with some participants in the market, not sure which ones, that have rebid some of their capacity out of the market now that there's that price cap of $300 per megawatt hour. So this is something that AEMO can override and direct some of that generation back into the market. And that's why I believe we haven't seen any blackouts so far. And this is probably more of a gas issue than a coal issue, simply because the price that you can theoretically buy domestic coal at should provide some gross margin to those coal-fired plants that can get access to it. Whereas spot prices for gas would push their net back price above that administered price cap. So I suspect it's mostly a gas issue. AEMO can and does direct people on, and those generators that do get directed on can go through a process to try and recover their costs. So it does add to a bit of the short-term noise and confusion about what's happening in the market. But what it means for the two listed companies in particular, AGL and Origin, I did put a note out on Friday. AGL is having some issues with some of its New South Wales plants. 3 of the 4 units at Bayswater were offline as of yesterday afternoon, and I do expect that will have some impact on earnings in FY22. But these outages aren't expected to continue for too much longer. One of the units is expected back next week, and the other 2 aren't too much further after that. It's a different situation to Loy Yang. Loy Yang Unit 2, that unit which has been offline for a long period of time and probably will be till late September, it uses some non-standard components, so that it's not off the shelf, the replacement parts, which is why that unit has been offline for so long. So that's a fairly unique issue to that plant in particular. So as I said, I don't expect those New South Wales plants to be off for anywhere near as long. The extended Loy Yang outage, though, has impacted my AGL earnings forecast for FY23. So I've brought it down by about 12%, but I've only reduced my target price by 2%, and here's why. So we're seeing accelerated increases in retail prices. The AFR reported that Origin is increasing some customer pricing above the default market offer. Typically, retailers would charge between 15 and 20% below. And I think I mentioned last time I was talking about electricity stocks, Origin hinted that they might go as high as the market offer, and now it seems they're actually exceeding it and rising higher than that. And this is really being driven by the cost of energy. So network charges and environmental costs are 2 other important components, but they're not really moving the dial here. It's really about energy costs. So while AGL's outages aren't great in the short term, there are limited the impact is going to be limited to a short-term issue. And in the medium term, we're going to see those customer contracts roll over into much higher prices, which I think really outweighs the short-term impact from Loy Yang and to a lesser extent New South Wales. So for some context, just to put it in numbers, assuming the Unit 2 at Loy Yang was out for a full year, and no one's suggesting it is, but just as an example, if it was, that would be about 5 terawatt hours of energy that AGL wouldn't be able to sell, whereas the retail book is about 15 terawatt hours, so about 3 times the size, and there's 10 terawatt hours of industrial customers, commercial industrial. So that 15 terawatt hours is going to reprice in the coming financial year, and probably a substantial chunk of that C&I customer load as well. So in my view, as I said, the tailwinds behind the company are much stronger than those short-term impacts, and I think AGL is clearly my pick of the electricity stocks. Origin, I think it's still too early to get excited about it yet. Eraring's output has started to nudge up in the last few days, which is good. But as we know, winter is coming or really here, and I don't know that they've really resolved those coal supply issues. There might be individual days where they're able to rail in a bit more coal than they have done. But without Mandalong back online, that's the coal mine that feeds Eraring. I'm still probably a little bit cautious on it. There's also the issue of gas potentially being directed away from the LNG exporters in Queensland to feed the domestic market. We don't really know how that's going to land yet, so that's something I'm also watching. And then the final thing is Origin in the medium term. It does have a structurally short energy position, so it doesn't have it's only got about half of its customer demand covered by its own generation. So I don't know how long its hedging contracts will last for. It said it was covered but for the Eraring shortage this year, but I don't know what the longevity is of those contracts. So they will be exposed at some point if wholesale prices remain elevated for a prolonged period of time. So comfortable retaining a hold on Origin, but as I said, AGL I think is a pretty comfortable add.